So lately, a few of my clients and friends, they have reached out to me because they're concerned about having their money in the banks. So I wanted to explain a few things about the banks and why you should not keep your money in the banks. And so you understand the difference and how can you protect yourself. So one of the very first thing that we have to understand about the banking is that whenever you as an individual, you go and you deposit your money in any major banks, you are an unsecured lender. What it means is that when you deposit your money, you're telling banks, let's say Bank of America, that Mr. Bank of America, I am giving you a loan, which is unsecured. So in order for people to trust the banking system, what happens is they came up with something called FDIC, Federal Depository Insurance. It means that it says that any major banks that you go, B of A, Chase, Wells Fargo, Citibank, US Bank, they all say we are a member of FDIC. So now people, they start having trust that the banking system, it's fine, it's trustworthy, and we can put our money and we should never have a problem. Well, there is so much lies about this whole situation that I'm trying to uncover it for you guys so you guys understand and make a much, much better and much more intelligent decision about where you keep your money. So the fact of the matter is that, first of all, the idea of FDIC is that for every individual account that there is in the banking system, every time when you make a deposit up to $250,000 is insured and you're not going to lose it. For example, they said that if banks, they go under, if your money is in the bank that is FDIC insured, up to $250,000 is protected. So if you have $1 million, you can forget about your $750,000. Only $250,000 will be protected, insured, and you're going to get that money. And anything above that, there is no guarantee. Now, this is the biggest problem that you guys have to understand and remember, which is very dangerous. In 2008, when the economy crashed and we went through great recession, financial recession, the government, they bail out the banks. So they bail out the banks because they were going under, and this was going to create an unimaginable disaster for the world and US. So the government, they bail out the banks, and so we can continue having a normal economy. Right after there was a law by Dodd-Frank that he wrote the law and it became and it was approved, and now it's a law. So what is a Dodd-Frank law? The Dodd-Frank law, it says that if in the future, if we ever come across to this situation, we are not going to have a bailout. In other words, the government, it's not going to bail out any banks in the future. So then what's going to happen? Well, what's going to happen is you're going to have a bail-in. So Dodd-Frank, the law says that you're going to have a bail-in. In other words, this is what's going to happen. If tomorrow the recession happen or depression happen of the banks, they go under, all of our money that is in the bank deposited, the banks, they have the right to use their money, use our money. They have the right to use our money to bail themselves out, and in return, they are going to give us shares in a failing bank. So I don't know if you guys understand what's happening. This is absolutely crazy, dangerous, and reckless. So you go to bank, you make a deposit, you are an unsecured lender, you lend your money to the bank, they take the money, They use the money. They do all kinds of different investment. They make a lot of money, and they give you, what is it, 1-2%, 0.5% interest on your savings, not even checking. And when the recession comes, if the banks, they go under, you don't have a right, you don't have a say. They're going to use the money, that it's your money, and they are going to bail themselves out, and they're going to give you a share in a bankrupt bank. That's Dodd-Frank law. And if you guys don't believe this, see what happened in Cyprus a few years ago. They shut down the banks. People, they could not access their money. They could not access anything at all. So, having said that, what you need to do? Well, first of all, what you need to do is, if you can, you need to take your money from banks and open a brokerage account, something like Fidelity, and put your money in the brokerage account. Why? Why is that? Well, here's what's happening. First of all, right now, as we speak, go ahead and Google it so you know what I'm talking about. There is about $19.6 trillion of deposit in U.S. banking system. $19.16 trillion. It's in the banking system. Okay? So you've got 19.16 billion dollars in the U.S. banking system, and you have FDIC, which insures your money up to $250,000. There is a new video that came out on YouTube, go ahead and watch it, about FDIC, that FDIC is bankrupt. They don't have any money. If they have anything, they have $5 billion. 5 billions, $19.6 trillion. So who's going to get the money? If you that are listening right now, if you have money in the bank, and if the bank go down, they go under, do you think you're ever going to see that money? Impossible. So what's going to happen? They maybe take 50% of your money without your discretion. They're going to take that money, they're going to use it to save themselves, and then they're going to issue a certificate that you are a part owner as a corporate shares, and your 50% money is gone. It is impossible right now for the FDIC to be able to bail out people, because it's not even, you can't even understand. It's astronomical. $19.6 trillion, $5 billion. So, my recommendation to you guys is that take your money out of the big institutional banks. Either put your money into credit unions, because credit unions are not like big banks, even though they are FDIC, but they don't have reckless investments like big banks they do. Or better yet, you can go open a brokerage account, put your money in a brokerage account. As I said, you can do something like Fidelity. Why? Because if you put your money in the brokerage account, okay, you are not going to be part of the bail-in. You're not going to be a part of a Dodd-Frank law. Why? Because the brokerage account is not a banking institution. Secondly, there is no FDIC. It's called SIPC insurance, which stands for Securities Investor Protection Corporation coverage, up to $500,000, and $250,000 will go towards to the cash that you have in your brokerage. But all in all, you have $500,000 coverage. So my recommendation is that go read, educate yourself. Whatever I'm saying, go Google it, find out about it yourself. It is not safe to keep your money in institutional banking, especially with the Dodd-Frank, especially with what he said in the law, which is a bail-in, not a bailout. That means you're gonna lose all your money, and if you are able to get some of your money, most of your money is gonna go away, and they're gonna give you shares in a failing bank. Go study about brokerage account, SBIC, and also Federal Credit Union banks. This way, you will protect yourself, you protect your money, you protect your business, and you can have a peace of mind that you're not going to lose your shirt if the recession and all this situation that is happening gets worse and worse by the day. Okay? Thank you so much for watching, and good luck.